Hello, everyone, and welcome to another episode of the Lifespan Investment Series. This is episode 10. Joining me once again is Lifespan Investment Committee member, author, and publisher of the Payne Report, Jonathan Payne. Thanks for joining me, Jonathan.
My pleasure, Eugene.
So let's jump straight into it. And the first place I want to start with is in the US. So much of the talk at the moment with regards to the US is focused on the government shutdown, the potential for Democrat gains in the midterm elections, particularly off the back of sensational election of the new mayor of New York, Zoran Mamdani, if I pronounced that correctly, as well as the important meeting recently between Xi Jinping and Donald Trump. So much to talk about, Jonathan. So why don't we maybe start with the government shutdown, which seems to look like there's going to be a deal and that'll get resolved. And then we can talk about maybe the midterm election and some of the other things.
Yeah, fantastic. Yeah, thanks, Eugene. Always nice to see you, and always nice to have the opportunity of talking to yourself and, of course, everyone in the Lifespan community and family. We meet every 3 months, Eugene, and it's quite bewildering the amount that happens in between our respective interviews. So, shall we start with New York, or let's just do the U.S. as you say, the U.S. government shutdown very, very briefly. As we speak, it looks like there has been a vote in the Senate, 60-40. So, the Republicans have basically got the votes now to reopen the government. There's a couple of procedural votes that need to take place, and literally as we speak, they're going through the motions right now. And then, of course, it has to go back to the House where it had already been passed. It was the Senate that was the stumbling block because the Republicans required 60 votes in the Senate. Looks like they've secured those. So the longest government shutdown in U.S. history, looks like it could draw to a close. The leader of the House of Representatives has asked all members to return to the House within the next 36 hours for their vote, and one assumes it will get through the House of Representatives. So yeah, it's been a circus. The Washington circus has been in full display here, and you know what? At the end of the day, a lot of people are scratching their heads as to what it was really all about. A lot of posturing by both parties. Let's not be partisan here. Both parties posturing. But the bottom line is, Eugene, it looks like the government will soon be reopened. And it was getting really alarming. I must admit, Eugene, I was very happy that I wasn't flying in the United States in the last few days, because we're seeing more and more flight cancellations. And, when you start talking about travel safety and air traffic controllers not turning up to work, gee, it doesn't make you feel good. And I felt actually about 5 days ago when I heard that the air traffic controllers, the problems with them, and then many of them not turning up to work, I thought, you know what, this is going to be the catalyst that really energizes and focuses the mind on the damage being done by the government shutdown. The other, lots of politics to talk about. We'll cover them as briefly as we can. The city that never sleeps, the financial capital of the world, and of course we're speaking about New York. And I won't do my favorite Frank Sinatra New York song, but we have a self-described socialist, Zoran Mamdani, as the new mayor of New York. I don't know how to fit this piece into my jigsaw puzzle, but there it is. It is what it is. We have a socialist mayor of New York. And obviously the youth vote was absolutely critical in electing Zoran Mamdani. And boy, oh boy, are we going to have some fun watching the inevitable duel between the president of the United States and a 34-year-old mayor in New York. So lots of fun and games there. Does it have national kind of ramifications? Possibly not. Bit of a protest vote, and as I said, very much motivated by a strong youth vote coming out to put the 34-year-old into the office of mayor. And then, of course, we had two governorships, New Jersey and Virginia, both of them won by the Democrats. So it's hard to translate that into a kind of a national setting. But of course, as you correctly say, we're now beginning to think about the midterm elections, the all-important midterm elections for November next year. Now, of course, we're in November, Eugene. I can't believe it. We're nearly at the end of 2025. I don't know what happened to this year. It's been non-stop entertainment. But yes, our minds are now looking to the midterm elections. I'm not anywhere close to making any predictions yet about the midterms for next year, but it is going to be critical. And there is a lot of speculations the Republicans will lose control of the House, possibly not the Senate, but then we'll have split government. And then, of course, all the shenanigans and the circus in Washington, I'm sure, will not disappoint us.
Indeed. So, yeah, there's a lot there, isn't there? Just going back to the government shutdown, they do this dance every couple of years, right? Like, it's not something that's entirely new. You did mention that this was the longest ever. Stock markets and bond markets kind of shrugged. Little bit of crack, little bit of volatility, but everything, equity markets are still at all-time high. So, I mean, I'm kind of amazed at how desensitized markets are to these sorts of events. Like, people reading about it for the first time ever would think it's pretty serious, but it does sort of tend to happen every so often, and it's been happening for a long time. But anyway, it's good that it looks like a deal will be done. So maybe we could turn to the meeting between probably the two most powerful men in the world, or people in the world, Xi Jinping and Donald Trump, which looked like they're taking steps towards some kind of deal. What can you share about that, JP?
Sure. I said it in my weekly pain report in the lead up to the meeting in Busan in South Korea that this was the most important meeting of 2025. And I believe it was. And we know in the lead up to it, China had issued this extraordinary declaration of tightening up controls, regulation, and export of critical rare earth minerals. And we all know how important they are in basically the manufacturing of almost everything and anything. And so in the lead up to that, and in response to this new draconian regulation and control over the export of rare earths, Donald Trump, of course, reacted instantly and imposed an additional 100% tariffs on all Chinese goods coming into the United States. I just want to very, very quickly emphasize the rare earth restrictions were not just targeting the United States of America, they were targeting the whole world. Anyway, as we went into Busan, I wrote in my report that this is going to be the most important meeting of the year. And also I highlighted in advance of that meeting that ultimately Trump is more transactional than ideological. I, in fact, first used that phraseology in his first term. And I think I was quoted in the press and on TV describing Trump as transactional rather than ideological. And nothing has changed since his first term. Nothing has changed my mind. And we saw in Busan a very transactional Donald Trump. He basically knew he had to make a deal. Why? Because China had played its Trump card, and the pun is intended. Because, of course, the United States and indeed all of the world realized that if China actually implemented those restrictions on rare earth material exports, the world would pretty much come to a stop, and relatively quickly. So Trump had to do a deal. And so we had the grand compromise. And what we've got basically, Eugene, is a truce between these two great superpowers. You said correctly, these are the two most powerful individuals on planet Earth. And Trump actually said on Truth Social in advance, looking forward to the G2 meeting. In essence, Trump, as we know, respects power. And there's one other person on planet Earth who has, almost the same amount of power, and that is the Chinese president. So we had a really amicable, respectful, constructive, conciliatory meeting in Busan, lots of smiles, lots of handshakes, and everyone breathed a great sigh of relief because Trump was at his transactional deal-making best. Both parties moved away. Important at moments such as that, Eugene, to follow the Chinese media reaction because it's all state-run, and I read the Chinese media religiously every day, and all of them were glowing praise for the meeting, highlighting the words that I've just used, that the meeting was conducted in a respectful manner. Very important, that aspect and dynamic of the meeting. So here we are, and basically, that kind of the intensity of the trade war has dissipated, and lots of other side deals. We knew going in, the easy deal to make was soybeans. The Chinese have now resumed imports of American soybeans. The Americans also canceled the fees they were placing on Chinese ships that dock in US ports. There's a whole lot of subtext, but the bottom line is we pulled back from the brink. And both these countries realize now, finally, they have to do business with each other. You cannot have the two largest economies in the world implement a de facto decoupling. So many things stopped working. So huge sigh of relief, and it was good news, and good news in Busan.
Yeah, good. Okay. And still on China, the Chinese premier came out last week stating the Chinese economy will exceed $23.8 trillion by 2030, which would potentially make it one of the bigger. Would that surpass the US at that level?
No. The US economy again, and there's lots of different ways of measuring this. And there's one of the ways the IMF, World Bank used so-called purchasing power parity numbers on the basis of PPP. China is actually larger than the United States, but when you translate into US dollars, the United States is still quite significantly larger than China. But as I said, some economists quote the purchasing power parity adjusted number, and that would put China as the larger economy.
Right.
But in US dollar terms, it's not.
Okay, fair enough. In any case, it's good to see that they're sort of mending their differences because I agree. You want them trading. I think when the superpowers are trading and prospering off each other, I think that also helps keep the peace. But that's probably another conversation. Let's move on now and discuss bonds. And we've talked in the past about the term premium of longer dated bonds and the risk that globally governments may be unable to fund their spending. And we've heard of interest costs over $1 trillion in the US just on government debt. However, and a lot of this fiscal uncertainty potentially puts upward pressure on bond yields, which is potentially it's unusual in an environment where central banks are cutting rates. However, more recently, you seem to be a bit more concerned about deflation and unemployment in the US. So maybe you could talk about that and what those issues potentially mean for longer dated government bond yields.
Yeah, it's this is a really critical issue, and it's one that, and I think I kind of indicate primarily through my weekly pain report. That's the best way I communicate with people, because it's on a weekly basis.
Yeah.
And I think it's fair to say that for a period of time, I was very focused on the increase in term premiums across much of the developed world. And that, of course, includes the United States, but also focusing on France and the UK. And why was that? It was because, of course, we have this new fiscal reality where governments, particularly in the developed world, have accumulated excessive debt. We had the first kind of round of it as a consequence of the GFC following 2008. And then we had the really big shock of COVID, where governments, particularly in the developed world, spent unimaginable amounts of money and borrowed unimaginable amounts of money. And that inflated all their levels of debt. And then as interest rates rose post-COVID, we then saw this scenario of ever increasing interest costs on their outstanding debt. And at the same time running budget deficits, which meant they had to then finance that budget deficit through the issuance of ever increasing amounts of government bonds. So you've just got a really bad situation. High levels of debt, high levels of borrowing, and ever increasing high levels of interest rates on long-term bonds, compounding this fiscal problem. And I use the United States, France, and the UK as my kind of poster child of that. So that for some years made me believe that we'll see a steepening in yield curves, which we did get, and an increasing increase in the term premium on longer dated debt. That's not a happy combination. And I've been focusing on that. We also saw, of course, more latterly, some inflation expectations moving higher as a consequence of worries around the short-term ramifications of tariffs. However, so that's the Western developed world. But on the other side of the world, you've got this massive engine room, Eugene, of deflation. And we know that China is experiencing deflation. You've got outright declines in producer prices and also more latterly in consumer prices, although the very latest Chinese CPI data, not PPI, CPI, showed a slight uptick in inflation. But suffice to say, China is now an engine room of deflation. It's kind of reminiscent of Japan following the bursting of their property bubble and financial market bubble. So we saw a bursting of the Chinese property bubble. I would argue, in historical terms, the most epic bubble of them all. And that has just been continuing to deflate. So the real estate market in China continues to be a very deflationary force. But at the same time, the manufactured sector in China is seeing such extraordinary efficiency gains with the implementation of robotics and other forces. So we're seeing a deflation in capital goods prices, and China, to get out of their economic trouble, need to increase exports of capital goods. So they flooded the world with cheaper capital goods. So we've got this kind of juxtaposition where we've got some inflationary pressures in the West, and particularly in the services sector. However, in the East, and the largest manufacturer of capital goods in the world is namely China, of course, you've got this deflationary pressure from the East. So when you look at it from a West-East kind of tsunami effect, those forces are now colliding. However, in the background, we've had the advent and now seeing the accelerated implementation of artificial intelligence. So what I've been trying to do, Eugene, in the last, quite some time now, is to thread this all together. Where do we end up?
Yeah.
Because as AI becomes more popular and is implemented across companies, and I'm not sure if we're going to talk specifically about AI later, I'm a big believer in AI, and I believe virtually every company in the world is going to utilize and use AI in some way. And that ultimately, to me, will put, unfortunately, very unfortunately, upward pressure on unemployment. More people will lose jobs as AI is introduced. And so basically, you've got this very big picture, medium to long-term deflationary environment. But in the short term, we've got higher upward pressure because of tariffs, but we think that will dissipate as we get into 2026. accompanied by ever increasing financing demands from government. So I'm now kind of having to tussle this, and my jigsaw puzzle is getting a bit messy. So I decided to back off on my hard kind of core conviction view that long-term yields in the West will continue rising. I think we've kind of reached a point almost of equilibrium. And the other thing, Eugene, is the central banks in the West, have been cutting rates, short-term rates, because they're now seeing these forces of higher unemployment, and they're now seeing the disinflationary impact of AI. So how do I thread that into my jigsaw puzzle? So as I've said in our recent investment committees, I used to be kind of banging the table about steepening yield curves and elevated term premiums and longer dated Western government debt. I'm now backing off a little bit because I'm having to acknowledge some of those deflationary forces. I don't know if that makes sense.
Makes sense. I mean, in a sense that you've got inflationary pressures and from the fiscal situation. I mean, the Western world's been gorging on debt now for decades, and that creates risk for bondholders, right? So that's pushed up, and we saw a lot of that when the U.S. central bank started cutting rates, but long-term bond yields went up, right? Which doesn't make sense until you explain or understand the other forces at work there. But then technology tends to be deflationary, right? Whether it's AI or other technology. So whenever there's technological advancement, the cost of doing most things comes down. It'll put upward pressure on unemployment, I think. But then it also creates opportunities to increase productivity. So, but yeah, I can see what you're saying, that one will offset the other. And it's in a way, it's good to have opposing forces in that, because perhaps that creates a bit more stability with bond yields. I think the other point here that we haven't discussed is quantitative tightening, which is about to come to an end.
Yes.
Which leaves the door open. So quantitative tightening is basically central banks selling their bond holdings back to the market, which puts upward pressure on bond yields. Upward pressure on bond yields, downward pressure on price. If they were to stop doing that, that would be good for the bond market in a sense. Yields could potentially come down, but it also leaves the door open for them to go back to doing quantitative easing in a situation where they want to control yield. Is that right, Ish?
I think you're absolutely right. And I think you're absolutely right. And that's another factor that we've had to thread into this kind of conversation. It's another piece in the jigsaw puzzle. You're absolutely right to point it out. The cessation of QT, and then basically opening the door ever so slightly to the prospect of them returning to QE. By the way, at some point in time, I don't know when it is, and it's probably not something to throw into this conversation today, but we will see a resumption of QE at some point in time. Once these central banks and various people get the taste of something, they'll always come back to it, and we might even see yield curve control. But that's a conversation for
down the track, for sure. Anyway, I suppose the long and the short of it is we're less concerned about long-term bond yields, but there's still a lot of value in the high-quality credit market as well. So from an asset allocation point of view, but we might talk about that a little bit further on. We've talked about rates. Well, actually, no. Let's quickly talk a little bit about US inflation and US interest rates and the markets leading to Christmas. What are your thoughts on that, JP?
Yeah, I mean, we'll talk briefly. I mean, obviously, we had that delayed CPI report because obviously the BLS, people haven't been able to get the statistics together because they've shut down the government agency. And we had that very delayed CPI report in the United States. It wasn't really that exciting. The headline number coming in at 3, it was a fraction underneath. The kind of consensus was around a 3.1% annual rate, but the headline coming in at 3. And I think I'm right in saying the underlying, the so-called core CPI ex food and energy was also at 3. There wasn't too much excitement in the number. Are we going to talk about Australian CPI in this conversation? Because maybe, but just quickly cover off on Jerome Powell. We saw a relatively hawkish. I mean, obviously they cut at the last FOMC meeting, but it looks like the Fed has taken a kind of guaranteed Fed cut in December off the table. If you listen to Jerome Powell in his press conference, he was uncharacteristically hawkish, actually. I mean, I know this might sound very, very silly to everyone listening, but I mean, I don't think we should ever forget how humiliated Jerome Powell felt when Donald Trump made him wear a construction hard hat outside the Eccles building. Eccles building is obviously the Federal Reserve Board building in Washington. And he even actually physically pulled him into the camera shot because Jerome Powell was trying to stay on the sideline, the side of the camera, and Donald Trump was talking to camera, and Trump actually got him and pulled him into the camera shot before he delivered the kind of blow and pulled that piece of paper out of his jacket. and said, no, look how much this building's costing. And there was that little bit of disagreement on camera about the cost. I mean, it was just an extraordinary moment. Typical Trump.
Yeah.
And Jerome Powell, you could see, was just literally shrinking under the gaze of the camera. So, people say, oh, of course, Jerome Powell doesn't bear grudges or doesn't personalize decision making. You know what? I don't know about that. Anyway, he's going in May, and obviously Trump will get his way and bring in his own person. By the way, I think Kevin Warsh, I mean, not for this conversation today, but I think Kevin Warsh will get the nod and the job at the Fed. I won't talk too much about Kevin Warsh. But anyway, bottom line is, Powell and the committee looks like they're getting cold feet about delivering a fait accompli kind of rate cut in December. The market now is still pricing a December rate cut from the Fed, but it's not a sure thing as it was.
Okay. And so inflation doesn't seem to be ticking up as much as perhaps we were concerned about. The tariffs would have started to flow through, one would expect.
They are beginning to flow through. It's interesting, Eugene, when you break down the numbers, we're getting a little bit of a rise in capital goods price inflation, which is very much feeding off the tariffs. And I was speaking to what day is it today? Tuesday. It was last week. And a very interesting conversation with someone who does a huge amount of business in the United States. And I started talking about tariffs and what impact it had. And he said very little to date, because they're still selling off a lot of their inventory that they had accumulated. And he said to me, and this is someone who does a lot of business across the United States in the capital goods industry, out of interest. He said, oh no, there's a lot of inflation to come. He said to me that only just at the beginning of the impact of tariffs, particularly on the capital goods market. And so I take that at face value. I mean, he had no reason to make that up. No. And by the way, he's just did a tour of the United States, and he was speaking to me at the end of it. And he said, talking to all the big suppliers that he deals with, that they're now beginning to mark prices up on some of those capital goods. So, it's kind of hard to know who to believe in all of this.
We'll just have to wait and see. I mean, because that's been the concern, and that's probably one of the reasons Powell's being a bit more hawkish.
Yeah.
Because it takes a bit of time for all of it to flow through to the consumer, which is, I guess, what inflation is based on, right? Based on price for the end user. So, all right, let's. I also wanted to ask the question: do you feel that Australia could, in fact, be well positioned in this new economic framework with its access to rare earth minerals, JP?
Yeah, it's an interesting one. Funnily enough, I'll try and be as brief as I can. Believe it or not, Eugene, rare earths have been on my radar since 2011.
Yeah, right.
And I've had various conversations with all kinds of interesting people about rare earths. I was always flabbergasted that more politicians didn't really think very, very carefully about the stranglehold, the chokehold that China had over the whole world, not just the Western world. And we know that for a very, very long time, China has become the monopolistic kind of processor of rare earth materials. So rare earths, as we all know, the cliche, rare earth materials are not rare. They're in abundance all over the world. We've actually got a lot of them here in Australia. The thing about rare earths is it is very, very toxic and polluting to process them, and very complex. And so China, over many, many decades, became the main processor of rare earth materials. So people, if you had rare earth materials in your country, even Australia, you send them off to China and let them do the dirty work. And I use that phrase very carefully. California, for example, was home to a massive rare earth mine, and the environmental people said, no, it's too toxic, it's polluting everything, close it down. And so they shipped all their rare earth materials off to China. And China went, happy days, happy days, happy days, because they knew how critical all these things were. I'll give you one example. So-called permanent magnets are absolutely critical in so many different fields. And China produces about 93% of the world's super magnets. So they can shut down huge areas of manufacturing, whether it be cars, for example, the semiconductor industry, all of these areas, critical areas. Anyway, bottom line is they had the rest of the world in a stranglehold, and they began to flex their muscles first in, I think it was 2010 with Japan. Anyway, believe it or not, I gave a speech somewhere, and I was doing my geopolitical stuff. This is 2011, and I was talking about US, China, et cetera, et cetera. And this guy spoke to me afterwards. He said, I found that aspect of your speech very, very interesting about the forthcoming geopolitical, the rivalry, et cetera, et cetera. And then I said, oh yeah, okay, what do you do? And he told me. And anyway, he ran a very, very large rare earths mine. And we then started talking about the kind of national security ramifications. Anyway, from that moment on, I started focusing on rare earths, and I spoke to people, and I don't know who listens to this, but I'll say it. I'm being recorded, so I shouldn't probably say much of what I'm about to say. But I started speaking to people in Canberra, And I said, you guys, are you following this? Are you watching this? Yeah, kind of, yep, kind of, yep, kind of. Anyway, here we are, 2025, 14 years later, and everyone in the bureaucrats and politicians kind of allegedly woke up and went, oh my goodness, does China really control 90% of all exports? They kind of knew that already. But anyway, bottom line is Australia does have a lot of rare earth materials. We've got special relationships with South Korea that process some of them. But yes, it's yet another example of why we're a lucky country. We seem to always have things that lots of other people want, whether it be iron ore, natural gas, and of course coal. I mean, our coal exports, are one of the reasons why China has such a huge electricity power advantage over the rest of the world, because China is not shy to have coal-powered power stations, and they produce plentiful amounts of cheap electricity, which is why they've got an edge in the AI race, because data centers require vast amounts of energy.
Still focusing on Australia, Melbourne Cup Day unsurprisingly brought with it a hold on rates by the RBA. There was some concern around some recent higher than expected inflation data. We've said many times that Australian services inflation continues to be sticky, and it doesn't look like we're going to get the predicted rate cuts until next year. What are your thoughts about all of that here in Australia, JP?
Yeah, it's an important topic. Look, that Australian CPI number that we saw was an absolute horror show. Whatever way you sliced and diced that number, it was shocking. Every part of it was horrible. And, Michelle Bullock at the RBA is right to say, you know what, that was a shocker. And she said it pretty much in her press conference. And, not every economist in Australia, they all went, and they kind of tore up their inflation forecasts and threw them promptly in the bin. So if you slice and dice that report, I mean, goodness gracious me, electricity was the standout. And every Australian, I'm going to knock my profession. Every Australian has looked at their electricity bills in the last couple of years and gone, what the hell happened there? And so, no surprise, electricity prices have been rising very sharply. And of course, that was pretty much the key driver of the quarterly inflation number and also the annual rate. By the way, moving forward, we're now going to have reliable monthly CPI numbers. So say farewell to the quarterly CPI blockbuster. We won't see that again. We're now moving to a monthly schedule. We've had monthly, but we now know that the ABS is going to produce a reasonably comprehensive and reliable monthly CPI report. But let me just go through the numbers. So the headline number of 3.2%, obviously the Reserve Bank and economists tend to look at the trim mean. Trim mean, what was that number? 3% on an annual basis. Electricity, the key driver, 9% on the quarter. Wait for this one, 23.6% increase at an annual rate for electricity costs. By the way, Australia has a serious problem with electricity inflation. I don't think I need to remind my friends in Canberra, even though they are ostriches with their heads in a hole, pretending that Australia doesn't have elevated electricity costs. And by the way, virtually every company that needs a lot of power and that is closing down, they are saying, we can't deal with electricity costs. We can't deal with costs of energy in Australia. It's one of the highest in the world. So maybe the friends in Canberra can actually take note of that. But then we look at coffee. I mean, heaven forbid, wait for this one, Eugene. Coffee, tea, and cocoa up 14.6% at an annual rate. And then we've got rent inflation, again, quite robust. Services inflation, 3.5% at an annual rate. Very sticky, very stubborn. And now we're beginning also ominously to see capital goods inflation rising. And that's been a key disinflationary driver for some time. So we've got the worst of every world here. We've got unsustainable electricity prices. We've even got, heaven forbid, coffee prices going up. Rent, we all know the story there. And then now, of course, we knew about sticky service-based inflation. We've spoken about that before. Now we've got rising capital goods inflation. Whichever way you look at this, no wonder the RBA was in shock, and every economist in the land kind of took the day off just in case someone in the media asked them why they got their inflation forecast so wrong. So here we are, elevated inflation, December, forget about it for a rate cut. And now most analysts pushing out to May or thereabouts for an additional rate cut. So yeah, it was a shocker. What
were the expected numbers, roughly?
Oh, no, the expected numbers were much lower than that. Probably numbers near 2.8, 2.9.
Wow, that's a big difference. Okay, so well, that's a big change in terms of the prospects for interest rate cuts. I think we're behind the curve in terms of what was expected a year ago for this year already. And if now the average economist is saying it's sort of going to be the middle of next year, that's going to have a significant impact. And it's interesting that Australia seems to have a bigger inflation problem than the US based on that. And a lot of it is not to do with tariffs. So we're interested to see how all that plays out. So do you want to now maybe share your views just on equities and bonds, given everything we've discussed, and then we might talk about one or two other little things? JP?
Yeah, sure. maybe I mean, the conversation in equity land has to kind of almost start with AI
Yeah,
because it's the kind of
which I was going to ask you
phenomenon.
to talk about next, but if you want to talk about that now, yeah, go for it.
Well, it's just that, the whole Nvidia thing. My obsession and fascination with Nvidia now over several years, and I describe it as the Magnificent One because, of course, we have the Magnificent Seven, which obviously includes Apple, Microsoft, Google, and the likes, etc., Meta, and so on and so forth. But really, the standout of the Magnificent Seven is, of course, the Magnificent One and the most magnificent CEO on planet Earth, which is obviously Jensen Huang. I urge everyone listening to this to pay attention to every single word that man says. And by the way, the President of the United States calls him in the middle of the night on a regular occasion, asking his advice on various things. And by the way, whenever Trump goes anywhere in the world now, guess who he takes with him? Jensen Huang. So, this is the new world that we live in. And AI as a phenomenon and as a technological kind of revolution, I think is durable, it's real, and we're in the early innings of it. It begs the question then, okay, fine. Everyone kind of knows that. What about valuations? And I've said this for a long time that NVIDIA, if you look at it on a 2-year forward PE basis, and I've said this many times in my report, is actually not that expensive. And I think, Eugene, you and I had a conversation. If you look at the 2-year forward PE of NVIDIA, compare it to Commonwealth Bank of Australia, which I call the Commonwealth Bubble of Australia, the 2-year PE rate is about equivalent of CBA and NVIDIA, which is, I think, staggering. But anyway, so from a valuation
Ridiculous,
perspective,
I think.
I don't think NVIDIA is that overdone. But of course, the big number that everyone keeps talking about is its market value. And so obviously NVIDIA recently surpassed a total market value of $5 trillion. I mean, it is staggering. I mean, feels like 5 minutes ago they were $1 trillion company. Anyway, here we are. Now, the big question mark, Eugene, is about the hyperscalers, the Metas, the Googles, the Microsofts, and this huge, huge, huge capex boom, and whether or not we're going to get a return on invested capital. The whole conversation on Wall Street is, okay, fine, AI is real. We get that. All these massive hyperscalers think that this is a once in a lifetime generational thing to get ahead and be a big player in it. Therefore, we need to spend a lot of money on AI infrastructure, data centers. But the amounts of money being spent are, many, 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 many hundreds and hundreds of billions of dollars. And in all of their latest earnings, they all upgraded their capex for 2026. Meta in particular. Come back to them in a second. So that begs the obvious question. It's the only question. And that is, will these companies get a return on that massive increase in invested capital? And the jury is out on that. So that AI a bubble is predicated upon that kind of fulcrum of that debate. And my view is, I'm a believer, so hands up, I'm a believer in AI. I think the way to play it is to be in the name or the company that is making the hardware that is required to build and drive all this compute that is now being generated in these data centers. And happy days, Microsoft spending all this money on new GPUs from NVIDIA. NVIDIA is the net beneficiary of that. Then you've got some crazy things like Palantir, which I wrote about recently in one of my reports, so my subscribers will know that story. I mean, that, however, went to nosebleed levels. So we had price to sales ratios, not price to earnings, price to sales, well in excess of 100 times. You've got to draw the line somewhere. You've got to draw the line, even though Palantir is an extraordinary company. So I agree, there are pockets of excess in the AI story, but the fundamental foundation of the AI story, I believe, is intact, namely that we need to generate and build this huge amount of compute that will deliver AI to companies and households and countries around the world. So there's that kind of AI bubble thing. Now, we also know at the same time, look, I agree, valuations in the United States are very stretched in absolute terms, in relative terms, and in historical terms. So totally concur with that. And then also we know, if we just want to drill down into the kind of forensic side, put call ratios. The amount of people buying call options versus the number of people buying put options at extremes, at bullish extremes, meaning much fewer puts being purchased relative to calls. And then we look at cash balances, then we look at concentration risk, then we look at the United States as a percentage of global market capitalization, all these numbers near extremes. Then we look at the Buffett indicator, which is total market value relative to GDP, off the map. So absolutely, there's a lot of red warning signals. So my view on this is as follows. You don't just have to be in the United States. There's other pockets of the world where and we've had this conversation now for many, many months, Eugene. Emerging markets are attractive, very attractive in my view. And by the way, I think the emerging market, if you look at the ETF the emerging market index, EEM is the ticker. We're literally at the all-time highs here, and I think we're going to break through. So I'm still fundamentally positively disposed towards emerging markets. So you don't have to have all your eggs in the American equity basket. I mean, there are other options. I don't think I've answered your question. Bring me back to the question.
Oh, you sort of have. We talked about AI. I was going to go to AI next, but we've discussed that, and it was just around your overall views on equities and bonds, given what we've discussed, and you've kind of answered it. It's from what I'm hearing from you, you believe in the AI story, but it's not going to be perfect, and and the sort of valuations on the grandparents of AI, let's call it, your Nvidias, is reasonable when you think about the broader. When you think about the story, when you think about their earnings history, and you think about broader valuation, so they're not at sort of ridiculous levels of valuations got to just before the tech wreck 25 years ago or so, but they're high. And then, but the thing about, and then we talked a little bit about the AI bubble. The thing about the AI bubble, Jonathan, is I'm expecting there to be a lot of stocks, or a lot of companies that sprout up looking to take advantage of this AI boom, and for the market not to know how to price, and that's where we could get a bit of. I don't think you think, and correct me if I'm wrong, JP, but I don't think we think Nvidia is anywhere near bubble territory, unless there's a big shift. Like, one of the things that could happen to a company like that is someone comes out and surpasses their technology. From everything we see, we don't see that as being likely, because there's a big gap between what they can do and what most of their competitors can do from what we can see. But then, so there'll be a lot of AI companies that will come up, will have a great story but may not have a lot of substance, and markets can put obscene price tags on some of these things. Particularly, we're not going to talk about this today, but particularly when you've got such a large segment of the market that's retail, and perhaps not as well informed and not as well researched as institutional grade investors, who get it very wrong too, right? But it's a little bit different. So that's that part. But then maybe you want to comment on the rest of the market, which you kind of have in your statement about emerging markets. And we've talked about emerging markets for a while. We've had a healthy allocation to emerging markets for a long time, which is proving to be really good now. But have you got any more broad thoughts on equities? I mean, they're pretty close to their all-time highs. They've made a record number of all-time highs this year, particularly in the US market and the Aussie market. So do you have a more broader view of equities?
Yeah, I would be very cautious on Australian equities. I think Australian equities are very, very expensive, whichever way you look at it. If you look at PEG ratios, that's the price to earnings growth multiple, as distinct from price to earnings. I mean, on a PEG ratio basis, Australia's one of the most expensive in the world, if not the most expensive, because we've got very anemic earnings growth expectations, accompanied by very high prices. And the poster child there is, of course, Commonwealth Bank of Australia, which has, obscene price to book levels and dreadful price to earnings to growth multiples. So yeah, I mean, we kind of know the CBA story. And Eugene, you and I have spoken about this now for some time.
Yeah.
But the bottom line is, Australia is an expensive equity market, and I just don't know where they're going to get kind of sensational earnings growth out of the market in the next 12 to 24 months. Whereas when I look at the emerging world, I think the fundamentals in the emerging markets are so much better. And we spoke a long time ago about this incredible situation where the fiscal ratios of the emerging world, excluding China, let's put China on one side, in the emerging markets is better than in the developed world, which has led me sometimes to very, very cheekily refer to places like France and the UK as sub-emerging markets, as distinct from developed. But yeah, so Australia, I would put in the expensive category in terms of a global equity portfolio led by, of course, the most expensive bank in the world, CBA. And then emerging markets, I think are quite attractive.
Yeah, and the US market is expensive as well. We talked about that earlier, but that's largely being driven by big tech and AI. But there's a story behind that. Interestingly, though, JP, and one of the other things we're seeing in both Australia and the US market is such a high concentration in terms of market cap of the top 10 or 20 stocks. So if you actually look outside of that, valuations aren't as ridiculous, right? Like if you take out the banks in Australia and a few of the other big companies, they're still stretched, but they're not as crazy, I would thought. And you could say a similar thing for the US. Would you agree with that?
I would agree with that.
Yeah,
I would agree with that assessment.
Yeah, and so when we're building our portfolios, what we've been trying to do is to look for, because the US is such a big part of world stock markets, it's sort of 60-70%, depending on which index you look at.
Yeah,
you can't not have a big allocation to it, right? So so we've tried to not have to be a bit underweight, but also find some pockets of value in the mid cap space, in the small cap space, emerging markets we've talked about, and also a real asset allocation to property infrastructure, which I'll talk about in a minute. Before we talk about the portfolios, JP, I want to get your thoughts on gold. We've seen it have a nice little pullback of about 10%. So it's sitting around $4,000 an ounce at the moment, unless there was a big move overnight. So do you think it's now become a very expensive insurance policy, or would you still be a buyer of gold at these levels?
Wow. How excited I get about gold. Okay. To address the big question, is it still an insurance policy? My answer to that is yes. The wonderful thing, though, about gold, Eugene, is we don't know how to value it because we can't value it. And so really the price of gold is anything we want it to be. And we can use our imagination. It's a wonderful thing in that regard. But just to be serious for a minute, I mean, gold has been a store of value for 5,000 years. So there's a lot has happened in the last 5,000 years. We think a lot's happened in the last 3 months since we last spoke at this forum. There's a lot happened in the last 5,000 years, and we won't replay. I'm sure most viewers will be relieved. I won't go through the last 5,000 years. The bottom line is, despite all the turmoil, the turbulence, revolution, war, famine, the gold has been this reliable store value. So that's point one. Point two. So we've got this axis of autocracy. We spoke about the Russian invasion of Ukraine and why that was a defining moment in history, and that led to a lot of central banks around the world accumulating gold. We now have an institutional bid, and we've got the retail bid, and we see that through inflows into the various gold ETFs. We now have major investment research firms publishing papers demonstrating that gold is a sensible inclusion in your portfolio because of its diversification benefits. So we've got all statistical analysis around correlations, et cetera. How does gold perform in times of stagflation? How does gold perform in times of other periods of dislocation? And gold, kind of does its work for you in a portfolio construct. So within the kind of universe of portfolio construction, there is this kind of argument to be made for gold. So those are all the kind of positives. Now, with anything like gold, it's ultimately a commodity, and as we've already discussed, we don't know how to value it. We don't do enterprise value to sales multiples or EBITDA or any other It's simply what it is. It's a commodity that doesn't generate any income, any dividend, or any coupon. So what does that mean? It means basically it's purely a function of supply and demand. And my argument remains, given I still believe that we have an axis of autocracy in the world, and I wrote about that just prior to the invasion of Ukraine. I think that's been amplified in the last 3 years or so. And moving forward, we have very high levels of debt in much of the developed world, anxiety around how that all plays out, particularly in countries like Britain and also countries like France. So basically, my broad macro fiscal / geopolitical framework of thinking leads me to believe that gold will continue to play a role as an insurance policy. So that means that opens the door to higher levels. But, and I said this a few months ago, when we had that surge in gold, we went up to 4,400, Eugene, 4,400. And I published a piece around that time or just before, watch out, it's gone parabolic. We need to come back down. And we dropped $400. So we're now trading, as we speak, the futures are 4,133. That's the front contract, 4,133. After that very sharp 10% correction, some gold people are saying, you know what, that was useful. We needed that breather because we just have got parabolic. Nothing ever goes on a parabolic curve forever. We've set back down. I mean, longer term, I speak to a lot of people about gold, as you can imagine. Some of my subscribers, I can only classify them as gold bugs. I hope they're not listening to this broadcast. And they're fanatics. I mean, they're complete fanatics. And they want me to say in my report that it's going to 10,000, and I've told them to go away. I mean, can it go to 5,000? Of course it can. Could it go to 10,000? Who knows? Because this thing doesn't have an intrinsic value. But coming back to the beginning, does it have a place as an insurance policy? I do believe it does.
Let's now move to the Lifespan Managed Portfolios. We're just going to quickly discuss what we've been doing over the last 3 months or so. I might start with fixed income and cash. Structurally, we've been sort of underweight duration, overweight high quality credit, probably underweight global bonds and overweight Australian bonds. We haven't really changed that. What we have done though is we've halved exposure to one of our global bond funds and moved that into a similar global bond fund. When I say it's similar, it has a similar strategy in that it invests in global bonds, but it has more flexibility to be more active. So it can have larger allocations to credit, larger allocations to sub-investment grade credit. We're not allocating to sub-investment grade credit directly at the moment because we think credit spreads are really tight. But at some point in time, that will become a good place to allocate, and we wanted some exposure to a manager who can do that. And so that's the reason for that allocation. But we haven't changed our overall exposure to global bonds. We've also replaced part of the exposure in a cash fund or a term deposit fund with an income fund that invests in, again, very high quality short duration bonds. So it's slightly higher risk than term deposit, still extremely low risk, but we expect to get a significantly higher return. And this fund is 60% invested in bank bonds. Sorry, it's 100% invested in bank bonds. 60% of those are Big Four banks, and the other 40% are Australian banks. So extremely safe, but more bang for buck for your money, because we do like high quality credit over cash at the moment, and you're not getting that significantly higher return for term deposits at the moment. Like, you're only getting maybe 20, 30, 40 basis points higher than the cash rate. Historically, that's been as high as 1 or 2%, but it hasn't been that way for a long time. So that's what we've done. That's what we've sort of done in the fixed interest space in the last 3 or 4 months. In the growth space, the main thing we've done is we've got a view that global REITs, which is basically global property, listed property, is undervalued. It's been a poor performer for a long time, and we haven't had an allocation in the portfolios for about 10 or 11 years, up until I think earlier this year or late last year. We started with a very small allocation in our strategic portfolios. So we've increased that. We think it's now a good time to go in, and I won't bore everybody with all the research behind that, but we just think on a valuation basis and structural basis, it's a good time to go in. It's also a way to get access to growth without piling more into Aussie equities and global equities that we already have a lot in. And we've also increased our exposure to infrastructure, global listed infrastructure, that is. And again, infrastructure investments can benefit well from inflationary increases because they can just pass on those increases to their customers, particularly where they're a monopolistic type piece of infrastructure, which you often find in various places. And we've actually reduced our allocation to Australian REITs. Again, it's largely based on valuation. We think global REITs and global infrastructure will do better, but we still have a place for Australian REITs in the portfolio. So they're kind of the main changes that we've made that are worth talking about. And we still have a decent allocation. We're still underweight growth and equities, but not too underweight. And we've got a fair bit of exposure outside of the very large cap Australian and US stocks. And we've sort of already discussed that, so I won't go into it again. Jonathan, did you have anything to add to that, mate?
No, that sounds pretty comprehensive to me.
Yeah. Okay, good. So that's where we're at. Thank you once again, Jonathan, for spending this time with us and going through all of that stuff. Thank you to everybody for listening. If you have any questions regarding anything we've discussed, please don't hesitate to reach out to your Lifespan advisor. And if you don't have an advisor, you can contact Lifespan directly, and we can find one for you. So thanks again, and all the best.
Thank you.